Welcome to the beginner course for market makers. My goal is to turn everyone here into profitable traders, phenomenal traders, professional level traders. This course is a gift to all retail traders who are willing to work with me. The material is not particularly difficult, but the subtle differences we will practice here will seem hard in the beginning. Sometimes it might appear as if we are going against the grain and against consensus or against the herd, and we will start to feel uncomfortable or out of place. And this feeling of uncomfort and feeling of being out of place is especially so for our more advanced traders who has become accustomed to a particular way of trading. But let me assure you that any feeling of discomfort swiftly disappears as you realize that the logic behind the process here works. We differ from other courses in that we need to see proof of work. We will need to be satisfied that you are working and that you are improving with every single step. If you haven't yet completed the methodology of pure trading course, then do so now, because it's in that course where I explain in more detail what it is I need to see from you. Initially, I was just going to jump straight into the strategy, the nuts and bolts, the entries, the stops, the target placement. But to be fair to the newbie traders, I've decided to dedicate this first lesson to them, to help them get on board and start with a good foundation of what Forex trading is all about. So this lesson, even to the advanced trader, it could be seen as an experience of and a practice for patience. So advanced traders, kindly be patient. The good stuff will follow shortly. But for now, let's start with Forex 101. So what you will learn in this course, the beginner strategy, who it is for, what it is. You will learn what a currency pair is, what a price chart is, what a Japanese candlestick is, what a pip is, what a market order is, what a pending order is, what the market state is, and what a trending market is, what a ranging market is, and how to determine the market state, and then finally what a contrarian trader is. Now these terms needs to be understood even by the more advanced traders, because we are going to talk about the market state, and that is basically the course that nobody really goes into, even though it's a very, very important one. So what a market state is and what a contrarian trader is also very important, because the way a trend trader makes money in the market is different to the way a contrarian trader makes money in the market. So Forex trading, the concept is simple. You make money by buying low and then selling high. So you buy something when you believe that the price of it will go up. So anything, any asset. In this market, we're talking about currencies. So we aim to make money by buying a currency and then by selling it when the price has gone up. And then you sell something, you sell an asset when you believe that the price of it will go down. And again, in Forex trading, we sell a currency and we buy it back when the price has gone down. There is no crystal ball or holy grail that will tell you the future for certain. However, as a trader, you work towards getting the probability on your side with a good strategy or an edge in the market. So traders use a statistical edge to help them make money by determining the probability that the market are at extremes, and then a potential direction change. So a trend trader, he makes money by following the trends, and a contrarian trader and a statistical trader, we're looking for an edge to determine that the market has reached a potentially high level or a potentially low level. Then we're looking for a direction change. So the logic as a contrarian trader is that you determine when the market has reached a potentially low level and then you buy. And if you determine that the market has reached a potentially high level, then you will look for selling opportunities. So how do you determine that the market is high, or how do you determine that the market is low? That is what the beginner trading strategy is for. So in the beginner course for market makers, it teaches us an easy step-by-step method to determine if the market has reached a potential high or a potentially low level on the higher time frame charts. And then the moment to buy or sell, that is determined on the lower time frame charts, the trigger charts, the 15-minute charts. So the beginner market maker strategy was developed with a focus on 8 major currencies, and then it's 28 different currency crosses. So we will be trading the euro, the dollar, the pound, the Japanese yen, the Canadian dollar, the Swiss franc, the Australian dollar, and the New Zealand dollar. And those currency crosses, which are 28 different pairs. You can, however, use this method on most other tradable assets. So leverage trading, guys, or leverage trading where foreign currency is concerned, or trading on a margin, carries significant risk and may not be suitable for all investors. So I advise you to carefully consider whether trading is appropriate for you based on your personal circumstances, because you may lose more than you invest. We recommend also that you seek independent advice to ensure that you fully understand the risks involved before trading. The information on the website, Pure Trading, or the YouTube, it's all intended as educational in nature, and I don't recommend that you buy or sell any specific financial instrument. It's not a signal service. But let's get started. This is what we will cover. So a currency pair, it's an exchange rate between two currencies. The currency pair shows the price at which one currency is exchanged into another. Example, if we are quoted the euro versus the dollar at 1.1128, then this means that 1 euro is exchanged for 1.1128 US dollars. And the two and the 8 decimal points, those are called pips. Again, if the price is quoted at 1.1128 for the euro versus the dollar, then this means that it would cost 1.1128 US dollars for 1 euro. The price that is quoted on the left, in this case the euro, that's called the base currency, and that's always equal to 1 unit. So if we follow an example here, 1 euro is equal to $1.1128. And if we look at a price chart, then on the price chart we can see that the price is on the right hand side of the chart and time is on the bottom. Time runs at the bottom side of the chart. Chart type that we use is in the strategy is called a Japanese candlestick chart. So it's made up of shapes that look like candlesticks. In the more advanced courses, we also make use of powerful Heikin-Ashi or Renko bar or even line charts in our strategies. But for now, let's just remain focused on candlesticks. Each candlestick shows how price has developed over time. We refer to this as a time frame. A daily time frame therefore means that each candlestick shows the price development over one day. In the beginners level, we will focus on the daily chart and also on the 15-minute time frame. The thick part of the candle is called the body, and this represents the prices at the beginning and at the end of a period. And the thin part, or the wicks, it show you the maximum or minimum price during the period. So if the candle is hollow and white in our example here, then prices moved up during the period, and if price is solid and black, it's moved down during the period. A pip is used to measure how far prices moved. So when we talk about an exchange rate, if you hear exchange rate on the news, or if you're doing a physical exchange at a currency exchange office, then you might say that the price at the moment is 1.11. When we talk about exchange rate between the euro and the dollar, you might say that the price is currently trading at 1 spot 11 cents. That's for non-traders. They would usually only use the 2 digits that follow the decimal point. However, pips are how traders generally measure their profit. So if a trader buys a currency pair, for example, the euro versus the dollar, at 1 spot 11.00, and the price moves up to 1 spot 11.28, then it is said to have moved up by 28 pips, or the trade has gained a 28 pip profit. Some trading software, which is typical for ECN brokers, they make use of 5 decimal places, in which case the 5th decimal point is called a fractional pip, or sometimes it's called a pipette. At Pure Trading, we measure our profits and losses in percentage instead of pips, but we will touch on risk a little bit later on. So in this example, the price is at 1 spot 11.00 and price moved up by 1 pip. So prices are now currently 1 spot 11.01. So depending on your risk tolerance, if you have traded this, then 1 pip could have been equal to $10 if you were trading a standard lot. Trading is when we exchange one thing for another. This used to be called barter when there was no universally accepted means of exchange like the currencies we have nowadays. But in the context of Forex trading, trading is the exchange of a certain amount of one currency into a certain amount of another. So this exchange happens at the current quoted price. For example, if the price for the euro dollar currency pair is at 1 spot 11, it means that we can get 1 euro for every 1 spot 11 US dollars. In other words, it would take $1.11 to purchase 1 euro. And on a chart example, you can see that prices are at 1 spot 11.46, and this means that you can exchange 1 spot 11.46 for 1 euro in this example. The euros are the base currency, which means that it is always equal to 1. And the dollar is quoted on the right hand side of the chart, and in this case it's 1 spot 11.46. To activate an easy way to take trades, you right click on the charts and then activate one click trading. From here you can buy, or when you believe prices will go up, and then you can sell if you believe that prices will go down. This way you can easily buy or sell at the current quoted market price. You can click the up or down arrows to increase the lot sizes. So in the example here, you can see that the lot sizes are set at 0.07, which is equivalent to about 70 cents per pip. And the current sell price is at 1 spot 11.55, and the current buy price is at 1 spot 11.56. The difference between the buy and the sell price here is called the spread. This is what the brokers charge as a fee for using their services. In our strategy, I prefer to use only 2 types of orders though. I will explain an extra 2 types, and I'll explain why I'm not a fan of the extra 2. So you buy at market price. That is the one that I'm not a big fan of. So if prices are at a level that you want to do business at, you can use the one-click method. For example, you can buy 0.5 lots at 1.1152, and then you can drag the green line down to place the stop loss. So you place the order by right-clicking on the chart, and then you can right-click on the line and draw the stop loss. The second type of order is a sell at current market price. So in the example, it is 1 spot 11.46. So in this example, we have a stop loss of 23 pips and the target of 33 pips. Stop loss is the risk tolerance, how much you are willing to risk losing on the trade. And the target of 33 pips, this is the amount that you would like to make before the trade closes. Now these are the types of orders I want to concentrate more on, because these are the types of orders I use in the beginner strategy. So a buy stop order. This is the preferred method for taking an order with a strategy. Instead of waiting for a specific price level to be reached before placing a trade, you can instruct your trading platform to automatically open your trade when your predetermined price level is hit. We call this entering a pending order. You can tell the software where your entry, where your stop loss is, and where your profit target is. Additionally, we can instruct the MetaTrader platform position size or the risk we want to take. The software does the rest. So when using MetaTrader to enter a pending order, it is important to know that when you wish to buy, you select the type buy stop, and when you want to sell, you select the type sell stop. In this example, the price is currently lower than your preferred entry price. We want to see prices go up and through our buy stop order. We place an order in our platform and wait to see if we are filled. There is no need to sit and watch the chart all the time. The trade is triggered automatically after your order is placed and prices reaches your level. A sell stop order in this example, price is currently higher than your preferred entry. So we want to see prices go down and through our sell stop order. So we place an order in our platform and wait to see if we get filled. There's no need to sit and watch our charts again. The trade is triggered automatically after your order is placed and price reaches your determined level. Only a few more terms left to understand before we get started with the good stuff. So I would love to get our beginners on board. So position size and the volume is how much you will buy or sell. Position size is the amount that you will buy or sell. The pure trading risk parameters for the beginners method should be adhered to at all times until we have our first meeting together. So a stop loss order prevents you from losing all your money. I'll explain the exact amount for the stop loss later on in the course. So if a trade goes against you and you bought and the price of the currency starts to go down, the stop loss order will automatically close your order so that you don't lose too much money. A profit target, this is the amount of money you intend to make. A profit target is a predetermined price at which you will close your trade for profit. So the pure trading beginners method teaches us a unique technique for placement of targets, and that's all later on in the course. To help us out with risk management, we're going to use a tool called the myfxbook, and we'll use this tool for other things as well. But for now, let's just explain how we use the tool for risk management. You go over to the risk management tool, you click on calculators, and then you choose the position size calculator and you fill in your details there. All you need to do is fill in what you have on your chart. You fill in your account, your currency, the account size, the percentage that you are willing to risk, and you fill in the stop loss in the per pip size, and then finally the pair that you are trading, and then you click on the calculate, and then voila, everything gets calculated for you. There are better methods for doing this. We have a powerful tool that will help you with risk management. You will have access to this tool as a member. However, I would like you to firstly get used to this method and understand how to use the myfxbook tool for the calculations for now. Doing this manually is going to help you in the end, just to have a better understanding of how it all works before we introduce you to any sort of tool that can help you. Now off to the charts for an example of a buy stop order or a sell stop order. If you come to the chart and you are interested in placing a buy order, with the beginner method and the strategy, I recommend placing buy stop orders. So prices are below an area where you feel prices should go up towards. So this is a line where you believe prices should, from here, live prices, you believe prices should go up through that level. So what I'm going to do is I'm going to place a buy stop order. What you do is you right click on the chart anywhere above price. So when you're doing a buy stop order, you click above the price. You click on the trading button and then you click on buy stop. The volume, the lot sizes here are 0.02. So if we were to decrease the lot sizes to 0.01, or we want to increase the lot sizes to 0.03 or 04, what we do is we just head over to this little window on the left hand side. So what you do is you right click on the chart above the price if you're interested in buying. You hover on the trading window button and you click on the buy stop. And as you can see, if we buy at this level, it will be buying 0.04 lots. So, and we won't buy at the market price because we're doing a buy stop order. So if you notice where the buy stop order appears, it's right there. But the cool thing about this is that you can now modify this buy stop order to wherever it is you would like to place it. So now that your buy stop order is in, we need to make sure that we have a stop loss in place. So what you do is you hover on the green line, which is the buy stop line. You right click on the line and you click on modify the order. So the first thing after we place an order, we have to place a stop loss. And because we're buying, we would like the stop loss to be underneath price. So we decrease the price at the stop loss button and we decrease this just until this grayed out level here becomes colored, and in this case it will turn into a red color, I believe, or blue, sorry. So now you click on modify. Now we have a red stop loss line. So what you do is you can hover over the line and then you can drag the line down to wherever it is you want the stop loss to be placed, and then exactly the same thing when you place the take profit. So now you have your take profit window. You click on the arrows to increase the take profit, and then what you do is you increase the take profit until this grayed out area is modified and it turns into blue. Modify, and then we have a line that we can simply move up toward the area where you believe you could take some profits. And if you want to close the order, all you do is you click on this. This is your order here. This is the order that you've just placed. Your size, the price at which the order will be triggered, the stop loss, and the take profit. So if you want to close the order, you can click this X here, or you can go back onto the actual order, the buy stop order, right click on the order and then click delete. And exactly the opposite for a sell stop order. So say for instance you wanted price to come down into this area here. You wanted price to come all the way down and reach this take profit target here, but you don't want prices to go further up, or if it does, you would like to be protected. So in that case, what you do is you hover the mouse underneath price because you want to sell. Then you click on the trading button and then click on sell stop. Sell stop means that prices are above the area and that you want prices to come down through the sell stop and get triggered in. And to now, once your order is in a sell stop, you right click on the order, you modify your order, and then what you can do here is you can modify your stop loss. And in this case, you don't want prices to go much higher than this, and you have a limit. So you want your stop loss order to be above price, so you move prices up with the arrow. It's grayed out now and it turns red. As soon as it turns red, you can place the order, and then what you can do is you can move the line up, move the stop loss up to wherever it is you feel you want to place the stop loss. And then exactly the same for the take profit. You hover on the order itself, in this case the sell stop order, you click on modify, and then we have a take profit area here that we have to modify. So because we want to take profits down where price is further down, we create a line that is underneath the price. Then you move this price all the way down to where you believe take profit should be. So the actual place where we will be placing take profits is not taught in the course yet. I will show you all that later. This is just to show you how to actually place the orders using the beginner strategy. And to delete the order, once again, you can click on this arrow on the X here, or you can right click on the actual order here, and then it will be you'll have an option to delete.